Welcome to Module 1, Basic Steps to Pre-Approval. This is Module 1 of 4 to blueprint for your home purchase. Before you start looking at homes, it's important to get with a professional to make sure that you're looking for homes in the correct budget for what you're wanting to spend and also what you can be pre-approved for. So a quick story, I actually recently had a borrower call me and she was looking at a $700,000 house that her family saw riding around on Sunday on the weekend. They went to an open house and they fell in love with this home. She could imagine her family being so happy there. So the realtor asked her to call me. We talked, went over her financials, and it turns out, unfortunately, that her $40,000 a year salary wasn't able enough to carry the payment for the $700,000 house. Now, that's what we want to avoid. That's an extreme example, but we want to avoid getting your heart set on something, going out and looking, imagining where the curtains and the beds and the couches are going to be to make sure that we save you time and heartache and research in order to make sure that you're in the right place. Now let's get to lesson 1, preparing for the pre-approval and the pre-approval process. My recommendation is to start from 6 to 12 months out from when you're needing to purchase. You heard me, 12 months out. I love it when borrowers come to me and they're trying to forecast for the future. Not to worry, thinking that this might be a waste of somebody's time. It's actually the contrary. What we want to do is empower you with information. You're going to have questions. You might have homework or savings homework that's needed. So I always recommend, if you're starting to think that it might be time for a move and you're starting to find yourself looking at midnight in your slippers online to houses and imagining yourself living somewhere else, that's the time to call a lender. You're probably wondering, well, I don't want to pull my credit that early, Jennifer. Why do I want to pull my credit a year in advance? I understand everybody, myself included, is worried about their credit score and making sure that it's constantly going up. So credit is the number one factor that actually keeps people from making application. In fact, most companies, did you know, pull a soft pull on the credit, so it's not going to harm your credit score if you are inquiring with a mortgage company, in most cases for your mortgage loan. A year out gives us enough time to review what's on your credit, give you any updates that might need it, give you some homework that might help get your score in the right place for that purchase. Another important thing for you to know is that the credit score that you have access to as a consumer out there in the public is very different than what lenders pull. This is actually the number one myth or misunderstood fact that I hear every single day, is that clients will subscribe to things online. There's over 20, 25 different formulas of credit. Most people don't know this. And did you know that all lenders subscribe to the same one? So we have the same formula that's calculating the score. That's how we can manage loans between each other, because the integrity of the information is the same. And what we find, unfortunately, is someone might think that their credit is a 720, but in fact, maybe the model is 20, 30, even I've seen 70 points different on what we pull. So not to scare you, but just as a caution, it's a great idea to let a lender pull your credit, pull a soft pull, so that we can see exactly where you are. And so that's my recommendation, is to let a lender look at your full financials so that you can understand and make the very best decisions sooner than later. Another factor that's really important in the pre-approval process is income and employment. So we see lots of things out there as far as employment. Some people are part-time. You might be self-employed, you might be contract, or you might be W-2. All in all, what it's important to know is that you need a 2-year history of employment. Doesn't have to be with the same employer. If you've switched jobs, normally that's okay. Gaps of employment, be prepared to explain those, but make sure you have on hand all of your employers with dates, when you started, to when you finished for 2 years. Sometimes if you've had gaps of employment, we might need to go back farther. So make sure you just have that information available, similar to a resume. Now, if you're self-employed, it's important that you've been self-employed for at least 2 years. Most loan programs are going to require that you have a 2-year history of self-employment, whether you're paid 1099, whether you W-2 yourself, you might be incorporated, you might be a Schedule C. All of it is going to be analyzed the same way. So make sure you have those dates available, addresses where you worked if you were an employee, names of your company, maybe it's a DBA. So just gather all that info and have that ready. Savings is another component of what to expect. You want to have all your accounts listed out. We will need account numbers when we see your statements, but for the application process, normally just name of institution and balance is okay. That would include savings, checking. It would include stocks, bonds, money market, CDs, 401k, IRA. Those are what we call liquid assets, things that can be liquidated quickly. Now, in addition, you might own property, so make sure to have addresses available if that applies to you. Values, do they have any loans on them? So make sure that you have all of that available as well, including any land that you own. Lots of people forget about the land that they might have inherited, etc. Anything that's real estate related that has land under it or land on it, that's what we need to know. So make sure you have that information available. So you're probably wondering, Jennifer, how do I choose a lender? There's so many out there. There's banks and credit unions and lenders, and how do I even know where to start? This is a great question. The best place to start is with trusted referrals from friends, family, coworkers, people that have used mortgage services before. It's great to start there. And then you could also add onto your list, you might belong to a credit union. You might want to go to the bank that you bank. Make sure to make a list of those lenders, start calling those lenders, and you want to make note of things like, were they quick to respond? Did they answer my questions? Did they have patience to answer my questions? Were they easily accessible on phone, text, email, whatever your preferred method is to communicate? Do you have special hours that you need accessibility, like weekends or nights? Did they answer your calls during those times, or are they available during those times? These are important things for you to know as you're choosing which lender you're ultimately going to do business with. Now, during the pre-approval process, it's important to note that you could pre-approve possibly with 1, 2, 3. You could pre-approve with 10 lenders if you wanted to. You might not know that any lender that pulls your credit within a 30-day period just counts as one inquiry. Now, if they're pulling a soft pull of the credit, that actually won't go towards the inquiry. If a hard pull, some lenders pull a hard pull, so you definitely need to ask that question. That would count as one pull. And then any others in a 30-day period that also did a hard pull, it's all the same. It just counts as one. So that's really important for people to know. Most people don't readily know that, so I want to make sure that we talked about that today. So as you're narrowing things down, it's okay to have multiple people check, multiple lenders check into your credit. As you start to narrow things down, go with your gut instinct as far as questions being answered. Are they answering my calls, etc., quickly? That is really, really important, because remember, this is definitely a relationship. This is you putting your trust into whatever company that's going to get you to the finish line whenever that time comes, that's going to get your family into the home of your dreams. So not to be taken lightly. I would definitely make note of these maybe red flags, maybe green flags. You want to make a list and start narrowing it down that way. That's what I would do, and what I always suggest my clients to do is there's a part of it that you need to go with your gut feeling for sure. The last thing I'll mention about the lender is I truly believe that using a state local lender, someone that's in your community, that's what I mean by local, is in your state, Could be also your area, your city, your town, because they're going to understand programs that may or may not be available to you based on your situation. There's down payment assistance programs in every state that are different from state to state. So a national lender might not have proper information about local insurance, local taxes, and information that could be vital to making sure that you're in the right budget for your home. Now, coming to a close in this part of the lesson, I'll talk about one other thing that actually is crucial. Did you know that a lot of online calculators are not correct? So you might be looking at that perfect house online, using the online calculator. 9 times out of 10, when clients come to me with what they think a certain payment is, and they say, Jen, I got this online. Is it not correct? It's not correct. And that's because taxes online could be different than what your actual taxes will be when you buy the house. That's number one, because the seller might have lived there a long time. Their taxes are suppressed. Different counties have different benefits for homeowners based on longevity. So when you buy the home, the taxes are going to catch up to you, trust me. The other thing is insurance. So insurance in different parts of the country is higher or lower. I actually live in Texas. We have some pretty high insurance. We have hurricanes and floods and lots of hail. So insurance rates are a little bit higher than other parts of the country. So online calculators don't know this. Also, online calculators very often don't count PMI or private mortgage insurance in the payments. So all in all, it's important to know that by getting with that lender sooner than later, remember I suggested 6 to 12 months if at all possible, it's a great time to review what a true accurate payment is for the areas that you're looking for the home. And a local state lender is going to be really well equipped to do that for you. So make sure in your list of lenders that you have 1 or 2 on your list so that you can be getting the best advice. Now we're going to go on to lesson 2.